I mean, I think, as you saw around the time of Brexit, the best indicator was sterling US dollar in terms of what the markets were thinking the likely outcome was. Of course, they were wrong, as it turned out. If you look at the last few days, sterling has actually hardly moved against the US dollar. So, you know, went up prior to Boris resigning, then went down. But in terms of the FTSE going up, actually, most markets went up yesterday anyway. Of course, the FTSE is dominated by overseas earners, overseas currency translation, over 70% of FTSE 100 earnings. So you'd expect, if people expect the currency to go down, you'd expect FTSE 100 to actually outperform mid-caps and small caps in the UK.
Do you have any sense, net, whether where we are in this political story is positive or negative for UK assets?
It's interesting. When you actually meet clients, they're obviously incredibly worried about Brexit, and they're incredibly worried about UK equity exposure. But when you actually think about it in terms of the large UK firms, ironically, they were the biggest beneficiaries, actually, of the Brexit vote in terms of the fall in sterling and the translation effect and the currency effect on their profits, revenues and earnings. So I think the current sterling is probably a midpoint between, if you like, the no deal, where sterling probably falls at least 15 to 20%, to a relatively sensible outcome on the other side. I mean, there's still a possibility that actually you have to question, how does Mrs. May actually get out of this mess? Will whatever the deal to negotiate, A, will it work? Will the EU approve it? And B, will her Brexiteers who have previously held her to ransom, every time she's trying to move in a sensible direction, the kind of blackmail note has arrived at number 10. She's given in to the blackmail note every single time. Will she give in to the next blackmail note that she receives from, you know, the splinter groups of the ERG? We'll have to see.
So what happens for the FTSE? Because Brexit has proved negative in the past for the index, but then every time since then, when you've had pound weakness, FTSE's actually spiked. So what's the better outcome for the UK market?
Well, if you look at the valuation of UK equities, as we said earlier in the year, UK equities then were one of the most hated assets in the world, and valuations of UK equities, unlike many other international kind of peer group, were actually looking very low. So I think, like everything, if you look through the noise, you look through the valuation of the firms, you look through the price you're paying for those firms, whether it's kind of Glaxo or HSBC, whatever, actually the impact on Brexit is actually much bigger in terms of the mid-cap index and the smaller cap than the larger group. And while sentiment will swing according to whatever happens, whoever resigns tomorrow or the day after, actually they're more impacted by the currency exchange rate. And the currency exchange rate would depend on your view on which is the most probable outcome. And I think at the moment, sterling is in the middle of the, you know, there's three options. There's a kind of middle ground. There's essentially a kind of go back to the previous deal with the public at large, kind of maybe voting that through in a second, in a people's vote on whatever the deal is. And there's of course no deal whatsoever. And if you look at it, the probabilities of either the no deal or a second vote, both of those have probably increased, and therefore in a way it's sensible that the exchange rate hasn't really moved, because those two probabilities, one which would leave sterling actually higher in my view, and one which would lead sterling considerably lower, have probably both gone up the same amount as a result of the last few days.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.